Hello, everyone, and welcome to today's major market update for March 11, 2022. The market is biding its time. That's simply what it does. Why? Because we're essentially in a messy sideways price action thing. I don't know how to resolve this week from an Elliott wave perspective. The blue box here shows the price action we've been in. Down, up, down, up, down. I honestly labeled a couple of ABCs to it. I don't know how to resolve this. I've seen people thinking of diagonals, bounce, or either way. It's last week was very relatively easy with in this case, though we had an extended wave 5, but we knew we would get a wave 5. We had the bounce, etc. Impulse lower, and I said it was subdividing. Look here in blue, 1, 2, 3, 4, 5. That was great. And since then, it's been a mess. And this is how markets work. They go for clear to less clear, back to clear, etc. You can't have it easy peasy all the time. It's not how the markets work. So for now, we're still not below the February 24 low. It remains the line in the sand. We can ratchet it up to Tuesday's low pretty much. And that's really all there is to it. If we go below it, we know our downside targets. If we go above the highs made early March, we know our upside targets. Very simple. Regardless how this is going to resolve itself, my preferred view still remains 5.5 to 6,000. You probably call me crazy. Well, prove me wrong. That's what, and I don't want to see opinions, okay? But pure facts on why that is the case. I can provide you pure facts on why I see higher prices. But for now, this is the alternative option that we are in a ending diagonal C wave. It looks very diagonally, hasn't resolved itself yet. So this still remains a potential pattern, but it would fit with a C wave. Then we simply have wave A here, wave B here, and now we are in this diagonal pattern. And eventually diagonals, falling diagonals will resolve themselves bullishly, just as bearish, not a beer, I really need a beer though, bearish patterns resolve themselves bearishly, right? So this is a rising wedge, it will resolve bearishly. We have a falling wedge, it will resolve itself bullishly. Has it resolved itself? So this is the potential path. We had negative divergence here in the summer of 2021. We now have potential positive divergence in the winter of 2022. Lots of it. The price hasn't reacted to it. Remember, so far, it's only a 13% decline. That's it. How often do 13% declines happen? Between 10 and 15%. Yeah, about every 2 years on average, between 1.5 and 2.5 years. Every 2.5 years. When was the last double-digit decline we had? September 2020. So that's more than a year ago. Before that, we had a 30% correction in March 2020, which is 2 years ago. So far, the correction frequency and depth is nothing out of the ordinary. Okay, I just wanted to point that out, that if we can't handle these type of corrections, go to your bank, open a CD and put it in there and live happily ever after. These are simple market environments and corrections we have to deal with, nothing out of the ordinary yet. And as I showed on Wednesday, for those that failed to listen, it is my alternative option that we have already topped for the super cycle or cycle. There is plenty of room left to the downside. Don't worry. If we are expecting a 50, 60, maybe 80% haircut and we're only at 13%, we're miles away from the bottom. There's going to be plenty of opportunity to get out, so to say, and reassess. Remember, in bear markets, he or she who comes out the winner is the one who has the smallest losses. Nobody gets out here and nobody gets in here. Nobody does, okay? Of course, somebody will have been a seller here and somebody will have been a buyer here. That's fine, but nobody rings a bell at the top, neither at the bottom. So if one can prevent a 60 to 80% drawdown by jumping out after a 15% decline, you've done better than 90% of the masses. Please remember that. Stock markets are about minimizing losses. It's not about making money. That's secondary. You should not play this game. I'm sorry. That's the realistic expectation, because then it will prevent you from fretting, biting your fingernails, and all that stuff. The default is minimize your losses. If you make money, that's great. And I'll try to help you as good as I can with forecasting where things are going. But it's not that I say you have to lose money. It is a good mental baseline to have, like, oh, make sure I lose as little money as possible, just in case things go south. That is always your baseline. And then, of course, I want you to make money. That's something else. But the baseline is not profits, because it sets the wrong expectations. So far, again, a 13% correction. What's the big deal? Honestly, from this perspective, what's the big deal? Looks like a wedge pattern. Great. Shorter term, I don't know. I'm going to be frank to you. I don't know. I can scour 15 different edit waivers, and all of them are right and all of them are wrong, for as far as I know. Looks like impulse is higher. Like, for example, this rally since yesterday, it looks like 5 up, but we've already gone below it. So I don't know what that was. I just don't know. That's fine. Let's then have, and so this is then the wedge pattern. That's honestly all the price charts I really want to cover today. Let's go over seasonality. Seasonality suggests that we should find a bottom somewhere mid-March, and then rally into May, June, have some weakness, and then continue to rally. Slightly different seasonality here is that we're bottoming in February. I don't know whose charts these are. It's a little bit off more than this chart. I like this one better. So honestly, let's forget this one. All right. And then we're going to look at sentiment. Again, sentiment, this is from a little whiles ago, extremely negative. All right, extremely negative. And remember, as Jesse Livermore, a very famous trader, once said, markets are never wrong, opinions are. Everybody has an opinion about the market, where it should go, based on the Fed, based on the war, all these things. It's great. Maybe it will go up on the Federal Reserves. Maybe it will crash. I don't know. How the market will react to that is something different than what we see here. What we do know is that this looks like a pattern, that it looks like a wedge. That's what we know. Those are the facts at hand. And if this pattern comes to fruition, we should see a big move back to 4,600 quite rapidly. Just as we saw here, a big down move quite rapidly back to the start of the wedge. That's how wedges work, both to the upside, both to the downside. Here is Investor Intelligence Survey. This one is a little bit older, I believe. And as you can see, it is extremely sour. Not yet as sour on this tweet, I think it's from a week or so ago, as we've had at major lows, but every time we had a major low since 2009, the upside reward was, of course, fantastic. Newer data here as well suggests we are at important inflection point on bullish versus bearish advisors. This only goes back to April 2019, so it's a little limited, but we have often a good low when sentiment is this negative. How are the individual investors doing? Very negative as well. Not yet at 52-week lows. That was the end of February. But if we are going to get a washout low, wouldn't surprise me if we get a wedge where we see a false breakout or breakdown and then a sharp reversal. That is not uncommon for wedges to happen. Again, quite negative sentiment. This is very, I wouldn't say very negative, but quite negative. How are the active money managers doing? I would say the bigger boys. They're relocating a little bit, but still well below average. The long-term average, based on data going back to 2006, is at around 80% exposure to the markets. We get market tops when we are above 100. All right, not all the time, but it means we are leveraging, or the money managers are leveraging, and that often doesn't bode well. And again, we're quite underexposed the markets. How we're doing for market breadth. I told you on Wednesday we'd review some of the market breadth indicators. We have still potential positive divergence. It seems the lower we go, the less stocks are participating to the downside. So far, no reaction in price yet. That could be bearish, that we're not seeing it. That's for sure. but we are now doing better than when we were in earlier during this decline, especially here in early 2022. This was, by the way, for the NASDAQ. This is for the S&P 500. Also here, you can actually see for today, the bullish percent index went up a little bit, just by 1.4 points. But we have positive divergence versus the previous low. Divergence is only divergence till it's not, but it must be recognized. We had positive divergence here in March. Definitely not as much of a washout as in March, but it's quite the low reading. Let's go back a couple of years, and you can see we have quite some low readings that we don't see all too often. Ideal reading would really be below 30, but the market gives us what it gives us. How we're doing from a McClellan Oscillator perspective. The McClellan Oscillator tells you what the difference is between the number of stocks in an index that are advancing versus declining. So you subtract those two. Of course, you have also stocks that don't change at all. But the negative reading means that more stocks are declining, and a positive reading means that more stocks are advancing. Right now, it's negative. This is still data from yesterday. It doesn't update for today. But again, we're moving lower in price, whereas more and more stocks seem to be advancing. So that's a good sign. Again, divergence is only divergence till it's not, but it has worked quite well on several different time frames in the past. So it must be recognized. And so far, that still looks good. Same here for the summation index. Let's look at the summation index. What does the summation index do? It adds every McClellan oscillator to the data from the day before. So it's cumulative. Now, here we have a McClellan oscillator that I must update it from over 1,000, not 100, where we have a summation index that goes from above 1,000 to about current levels. And this data goes back to pre-2000 top. So we have considerable amount of data. We have essentially two bull markets or two bear markets, this one, and two bull markets. So it's reasonably good data to say, okay, we're capturing not N is 1. I've seen tweets where N is 1 or data, it doesn't say anything where it compares to something that has only happened once. That's not enough data, especially not from a scientific point of view. You need, of course, more data points. So let's look what happens to the market when it drops from, in this case, the summation index for the NASDAQ 100, from above 1,000 to below 1,000. Okay, so that happened in March 2020, and quite a low and a good rally. That happened all the way back here, going to, I would say, 2011, and that was quite an important low. Again, we had here this drop as well, 2010, from over 1,000 to below 1,000. And the last time it happened was essentially between 2003 and 2004, and the bull also continued. So 9 out of 10 times, I would say, right, we have a good reading. I don't necessarily want to compare the low readings, but I kind of want to compare what happens if we go from high to low, or kind of fall off a cliff. Is that bullish or bearish? Again, this is a very washed out market, can always drop lower, but please remember that at some point here, there's not much room left to the downside versus what is left potentially to the upside. So please keep that in mind. Please review this chart and assess the risk reward based on these charts. Have things really much more room to fall, or do they have more room to go to the upside? That is what we're kind of looking for. The same with sentiment. Does sentiment have more room to become more bearish, or is there more room for turning bullish? Now, some say the whole bull market is over, so none of these variables work anymore. There is something to say for it. Sentiment definitely is not the strongest of indicators for a turn. But we capture two bear markets and two bull markets. So I think that is a pretty good comparison, where you're not really looking at just one bear and one bull. And all of these still suggest, okay, that might be a good low, but we don't have a reversal yet, right? Price hasn't shown any reversal yet. We need to get back above the early March highs. That remains the line in the sand for the bulls. So how are we doing with sentiment of a McClellan Oscillator for the S&P 500? It's been teetering at around zero, all right, teetering. So you hear about teetering around zero, we need to see, of course, above 80 into the hundreds. If we get these spikes above 100, those are kickoff thrusts. Haven't seen it yet. We're just kind of stuck here at zero. We do have positive divergence ever since January. As you can see here, it seems like we're moving lower, but less stocks are participating. The same here, ever since, I would say, as you can see here, late February into early March, late March of 2020. You can see this whole pattern here. It took a long time before that kicked in, over a month almost, right? So this can take a long time as well. We're definitely further along, but we have to recognize the fact that we have now more stocks advancing than we did in January. Now we need to see price react to it. Again, we know based on Wednesday's webcast which levels should not be broken to the downside to know that we can still move considerably higher. So how is the summation index doing from the McClellan Oscillator for the S&P 500? Getting quite oversold as well, but history shows us it can get definitely more oversold. But when we get so oversold as we are now, then have a look at what, for example, the downside risk is. So here we have tiny downside risk. Here, the correction was essentially over. Here we had, of course, considerable, let me use this block here, considerably more downside risk, considerably more. Here we are very close to a bottom. This one was kind of interesting, also getting quite close to the bottom, as you can see. The same here, getting quite close to a bottom. So it seems to suggest that this is only going back about since March 2019, 3 years, that with such oversold readings as we have now, as I mentioned before, except for one, that was the crash in March 2020, the downside risk might not be as high as the upside potential. So please keep that in mind. We're getting very oversold. Again, price has not told us yet that the downside is completed. How are we doing sentiment-wise then from the VIX? Well, VIX, even though with a lower close on the indexes, the VIX is down as well. Interesting. Okay, one swallow doesn't make a summer yet, but it's interesting we have a lower weekly close, whereas prices have closed lower for the week. How are we doing for the buy all, sell all indicator? It's stalled out right here at around 14. I would really like to see a drop into the ideal buy zone, but what I wish is not always what the market gives me. But this one also seems to suggest that the downside here for this indicator is small versus the upside. It's still on a sell. I don't have any data yet for today. It should come in about 2 hours or so. But this also suggests that we should see limited downside versus potential versus upside reward. Now this one is, of course, still the warning sign. Way too many new lows. 52-week new lows are way too high. We need to see those taper down and drop below 50, right? At least drop below 100 to start off. What we do see here, I want to point out, and this is kind of similar, is as well negative divergence. So this is the NYSA new lows. So this is the and look here. The data for today is not yet complete, but it seems like also here the new lows are tapering off. How are we doing on the NASDAQ? Okay, how are we doing on the NASDAQ? It's right here. Is the NASDAQ making more new lows or less new lows? It is making less new lows. Price still needs to listen to it. It hasn't listened to it. It can always be negated, but it is quite interesting to see how price is moving lower here in red on the NASDAQ, whereas the new lows are also moving lower. So this suggests that less stocks are participating to the downside and more stocks are starting to rally, believe it or not. And the A is of course a, I would say, broader index, of course, than the NASDAQ, and this one has the same pattern, okay? So this starts to also suggest that the downside is weakening. It is succumbing to more buying pressure, that the selling pressure is dropping. If there is increased selling, we need to see more new lows. I mean, that's 100% logical conclusion to draw. This one still needs a little bit more time to update. Maybe we get a massive spike here at the end of the day, and it makes my whole story fall apart. That's fine, but so far this pattern is holding, also suggesting downside is not as strong anymore under the hood. And that, I think, is all I have for today. Again, the short term is quite messy. I can't give you much of a review on that one, other than that we have this potential wedge forming in the markets. So please consider your risk reward when reviewing these charts and your trading plans. Okay, consider that a lot of these indicators are quite washed out to the downside. Yes, they can always drop lower, but we do need to recognize the fact that there's a lot of divergences happening and that less stocks are participating to the downside. So the short-term price action was very clear last week, but it is much less clear this week. And this is how markets work. They go from clear to ambiguous to clear, etc. And unfortunately, we're stuck short-term in this ambiguous pattern. So because the indexes are stuck in this range, I can present you with two resolutions, either the wave 1-2 setup, or we have this ending diagonal setup, which is not yet complete. So regardless of how I look at it, both of these options should resolve higher, either more directly, the 1-2 setup, or we have first a flush lower into the 4,000 target zone, and then we rally. So nothing has changed this perspective yet. On Wednesday, I reviewed what if there is a top. I don't have it as the top is in, it's a what if. And please remember, sentiment is, I would say, almost extremely negative. Average seasonality is, however, bullish. It is average, so it doesn't have to be exactly like it is, but I showed you average seasonality is pretty bullish. And except for the semiconductors, all indexes are still above their February 24 low. That's the ultimate line in the sand, and I would like to ratchet up to this week's low, okay? We don't want to see it go below this week's low, because then we have a increased potential for reaching the low 4,000s on the S&P 500 and other numbers. But for now, it seems like the further we get away from that low in time, the less likely it is that we're going to strike that low. But we have still that wedge to consider. That's still there, no resolution. Again, BREF is really trying to become positive, but price is not reacting to it. So please take all those things into consideration for your trading plans. Right now, it's probably the best to sit on one's hands and watch and wait this out, especially since the price action this week has been far from ideal in understanding what the market really wants to do. And I wish it was easier. Last week was easy. This week, not so easy. So hopefully next week will be easy. We'll know soon enough. So thank you so much for listening. Thank you so much for being a valued premium member. Have a great weekend. Take care, trade safe, and I wish you all the best.